Hey boss, in today's video, I'll show you 5 methods on how the wealthy acquire wealth that the poor do not. If you're new to the channel, subscribe for more life-changing content by clicking the subscribe button below. Number 1. Keep track of everything. The ordinary person would have no idea what percentage of their money they spent on living expenditures and recreation last month if you ask them. If you ask them how much money they saved last month, you'll probably get the same blank face. This isn't surprising given that 61% of American people don't budget in any way. But if you ask a wealthy person, they'll tell you that planning and tracking your expenditure are key to financial success. Many wealthy people budget their money in 2 stages. They start by calculating their projected monthly income. This will include revenue from their job or business as well as passive income from their investments. The 20-30-50 budgeting strategy. When they use the 20-30-50 budgeting strategy, the total sum will be the starting point. This budgeting method divides your revenue in the following manner. Living expenditures such as rent, utilities, and groceries receive 50% of the budget. The remaining 30% is spent on entertainment such as going out to dine or seeing a movie. Finally, 20% should go straight into your savings account. The wealthy then meticulously track their expenditure after establishing a budget. Tracking of expenses. Most billionaires will link their credit cards to programs like Mint, which categorizes their purchases into budget categories automatically. Some millionaires, on the other hand, stick to the old ways. For example, they'll keep track of their purchases in their phone's Notes app and manually add up the totals at the end of the month. In any case, the wealthy keep track of their funds because they understand that what isn't measured isn't managed. While it may not seem vital to keep track of your spending when you aren't making a lot of money, the truth is that the sooner you begin to develop excellent financial habits, the better. And because you watch our channel, we know you'll be wealthy someday, so you'd better be prepared to handle all those million-dollar checks you'll be cashing in on in the future. Number 2. Financial discipline. Any millionaire would tell you that discipline is one of the most important characteristics in becoming wealthy. This is due to the fact that all facets of becoming affluent require discipline. For example, if you want a high-paying career, you must be disciplined enough to pursue a decent degree, which requires years of rigorous study and preparation. Alternatively, if you become wealthy by starting a business, you will need to exercise discipline to focus on your business even when your buddies are partying and having a good time. When you start making a lot of money, discipline becomes even more crucial. It doesn't matter how much money you make. You'll never be wealthy if you can't save, and saving requires discipline. It means getting behind the wheel of the car you've had for 10 years. Instead of spending tens of thousands of dollars on that new sports automobile you've been eyeing. If you read any big financial book or listen to any successful entrepreneur, you'll notice that one of the pillars of establishing long-term wealth is saving money. The shocking fact is that, according to CNBC, 57% of Americans have less than $1,000 in their savings account and 39% have no savings at all. We understand that saving money is difficult, but there are a few strategies we can use to make it easier. Number 1. Automate your deductions. In fact, setting up automated deductions for my pay with my work was one of the best things I ever did for my finances. In essence, these deductions allowed me to transfer a portion of my paycheck to a savings account rather than depositing the entire amount into my bank account. When I first started this process, I saved 10% of my actual tax income in my savings account. But over time, I've found that I'm able to up this amount to 20% and double my monthly savings. Setting up these deductions help you avoid spending your entire paycheck, meaning that saving money is guaranteed. Number 2. Start earning more. The other way to increase your savings is to start earning more. The truth is, your ability to save is restricted by how much you earn. But sadly, most people's only strategy for saving more money is cutting costs. Now, cutting costs is a great start because you can realize quick wins in the saving department. But realistically, you can only reduce your monthly cost by so much. You will always have to pay for things like housing, food, and transportation. Meaning that if you want to take your savings to the next level, then you need to focus on the other half of the income statement, which is your earnings. Consider how much of a difference an extra $100 per day may make in your finances. earning an extra 100 each day equates to almost $3,000 per month. If you merely save $75,000 of your excess income per month for a year, you'll finish up with $27,000 in extra savings. In conclusion, becoming wealthy is as much about earning money as it is about saving money. Number 3. Living within your means. Most people associate the billionaire lifestyle with wealthy individuals who spend vast sums of money on fashionable clothing and high-end automobiles. Millionaires, on the other hand, are careful spenders who live within their means. And one of the ways they've accumulated their fortune is by avoiding the income trap, which occurs when most individuals begin to earn money and continue to spend more. When you're earning $50,000 a year, for example, a conventional sedan might be fine. But if your income suddenly doubles, you could consider upgrading to a luxury vehicle. Parkinson's Law. Parkinson's Law is to blame for this increase in spending. According to Parkinson's Law, work expands to occupy the time available for completion. And in a financial context, it means you'll spend up to the amount you have available, which doesn't necessarily mean the money in your bank account. Which is why individuals go broke and then some by maxing out their credit lines and credit cards. This issue occurs as a result of a lack of financial control. Unfortunately, school only teaches you how to find the slope of a line and write in cursive, but not how to construct and maintain a budget, which are essential life skills. As a result, unless you have relatives or friends that instill strong financial concepts in you, you are almost certain to face financial difficulties later in life. For those who have their own enterprises, this habit of living on a smaller income is extremely vital. This is due to the fact that as a business owner, you will have good times when your company is profitable and terrible times when it's not. However, if you spend beyond your means while times are good, you will be unable to weather the storm of bad economic times and your company will most likely go bankrupt. Once you master the art of living within your means, it can set you up perfectly to begin employing method number 4. Number 4. Put your money to work. Life is like a game of Monopoly. The person who owns the best properties on the board makes the most amount of cash. Not only do these investments make them passive income as the game goes on, but they can be disposed for a significant lump of sum at the end of the game. However, you can only acquire these investments with your cash, which is why the rich put their money to work through investing. Unfortunately, when the average person gets paid, they either spend it or at best stick the money in their savings account. Now, putting money on your savings account is definitely better than blowing it on frivolous items, but the problem with this method is that sending money to your savings account every month will not grow your wealth. The average savings account yields to 0.09% interest annually, which means that even if you have $50,000 in savings, you would earn a measly $45 in interest. This is why the rich make a point to put their savings to work through investing, and the earlier they can start investing, the better. Just take Warren Buffett as an example. Buffett bought his first stock at age 11, and by strategically investing over the course of many decades, has become one of the wealthiest people on the planet. But it's not just billionaires who practice ongoing investing. On average, millionaires invest 20% of their household income each year, making investing a significant part of their wealth accumulation strategy. And if you think that millionaires invest in exciting products, you may be surprised that most millionaires invest in the same things as the average investor, like a Roth IRA and a 401k, but they also send these investments to include things like real estate properties and personal development. Number 5. Never touch the principal. At this point, we know that the rich track their spending diligently. The financially disciplined live frugally and put their money to work. But what really separates these wealthy individuals from the poor is that they never spend their principal. While I previously said that most millionaires live frugally, some do like spending on luxury items. And while you would think that spending large sums of money would reduce their wealth or even make them poor, it doesn't, because they never touch the principal. In financial terms, the principal is the original amount of money put into an investment. For instance, if you were to buy 10,000 shares for $100,000 that paid an annual dividend of $2 a share, the $100,000 you invested would be the principal and the $2 a share or the $20,000 would be the dividend income. In short, the rich never detract from the assets that are already earning them income, meaning that their wealth will never decline due to their spending. Rich Dad Poor Dad author Robert Kiyosaki alluded to this method of spending in a recent tweet where he said, "Live it up, buy everything you want. One caveat, buy the assets to pay for them first." Robert's been known to use his basket of investment properties to fund his purchases, like when he goes on vacation or buys a new car. Unfortunately, most people generate their cash flow in the form of active income by trading time for money. When you only earn an active income, it means that any money you spend is directly reducing your wealth, as income earned but not invested will never grow to a point where you can spend the excess cash it produces. So what type of investments can you use to make passive income? Some of my passive income methods include investment properties, dividend stocks, and real estate investment trusts. Investment properties allow you to invest into a building with down payment, i.e. principal entering cash flows through the profits you make from your tenants' rent payments. Dividend stocks are also great because they pay you quarterly or annually without you having to reduce how much money you have in the market. REIT or Real Estate Investment Trust. Real Estate Investment Trust is essentially a company that owns or produces income-producing real estate. You can think of a REIT as a mutual fund for real estate investing, and like a fund, the way you own it is through buying stocks. When you own a stock in a REIT, you are in a share of the profit which is produced by the real estate investment. It's a way to invest in real estate without the hassle of being a property owner, and every time profits are shared, you will receive your portions of the cash distributed. And the best part is that there is no property maintenance, nor dealing with tenants, and no chasing rent payments required. In conclusion, if you want to continue growing your wealth while still being able to spend from time to time, you must only spend the income that your assets generate and never the principal. Thanks for watching. If you want to go from the life you have to the life you deserve, then hit the subscribe button below.